4. Today, we're talking about the financing process, right? From the moment that you apply for a loan to what happens behind the scenes in the mortgage market, right? If you haven't seen some of the best movies out there about the mortgage crisis in '08, The Big Short's a great one. They have great analogies there. I really enjoyed when they talked about just making the fish stew. I won't spoil anything else, but if you still haven't watched that movie, that's a great, great movie. But today, I want to break down this information about the financing process so that even a fifth grader can keep. Because by the end of this video, I really want you to know about the different types of primary lenders, what happens in the secondary mortgage market, and how each stage of the process impacts your home purchase or your investment. And this is really important to me because I hope all of our kids eventually have the opportunity to buy a home. But more than likely, they're going to probably take out financing to finance the property. Well, in that situation, how do we prepare them for it? And I'm not talking about coming up with a big textbook or lecturing to them in a with all this fancy real estate words because well, people have told me that you had to read a book about what it means to become a real estate agent and you had to get your real estate license in order to be in real estate. That could not be further from the truth. I think if you can master the information by teaching the information, that's how you really become an expert at it. But I figured, hey, what's a harm? Let me look at all the content that they teach real estate agents so that I can see what they're really teaching them. I think it's very basic, but again, we can stay high level because I just want to be able to explain it to my kids so that they can learn it when the time comes. All right. So let's talk about the first part, right? Who lends you the money, right? We call these folks the primary lenders. And the primary lenders are the frontline folks who give you a mortgage, right? They might be a bank, they might be credit unions, they might be mortgage companies. You apply directly to them, right? You provide your financial details, which includes your tax returns, your W 2 pay stubs, your bank statements. If you have any transactions, they ask for extra proof. All these details they ask so that they can figure out whether or not you're a good risk, right? They underwrite you, which means that they look at everything from your ability to pay to how much existing debt you have under your name or in your credit report already, right? I This is the same exact concept, right? So then let's talk about the difference between the banks, the credit unions, and the mortgage companies, right? Banks and credit unions, they typically have their more conservative rules, but sometimes they can offer better deals, especially if you have been a long time customer, right? If you've been a long time customer of Bank of America or Chase, they might give you certain perks if you have a certain amount of deposits with them, right? Same thing for credit unions. They might be local to you, or maybe they are affiliated with you because of your, let's like the Navy Federal Credit Union, right? Maybe you're affiliated with the Navy. Same concept. Mortgage companies, on the other hand, they can be a little bit more flexible and they usually specialize in certain loans. Either route, it works, right? You have to figure out what fits your needs and gives you the best advantage, especially if you're looking to find the best fit for you for your situation, right? Because we talked about different loan types. Which institution gives you the best loan or the best loan type? That might be where very well where you choose, right? So I mean, it's almost as if you're trying to pick a place to eat, right? Or like a pizza place. The banks, I would consider them as the big chain restaurants, right? Domino's, Pizza Hut. They're reliable, but usually they're set menus. Mortgage companies, they might be a mom and pop pizzeria that lets you customize a lot of different things. They have their own spin on a certain type of topping or a certain type of sub. That's all it is, right? Again, I'm looking for better analogies. So if you have better analogies to share with me, leave it down in the comments below. Now, the secondary mortgage market. What happens after you get the loan, right? After you sign your mortgage papers, right? Your lender might sell that loan. Sometimes they call it paper, right? They sell that paper to investors, such as Fannie Mae or Freddie Mac. When they sell that loan, right, they're essentially getting back a lump sum of cash for that piece of loan or that note that they originally used to lend that money to you. This happens to me pretty much every single time I'm taking out a property, right? I take out a loan with a bank that I know, but eventually they sell that loan off to somebody else and then it gets serviced by another lender. It happens all the time. And this allows them to get back some cash so that they can make new loans, right? It's almost as if a big circle of money that allows lenders to keep helping new buyers. And this might be a good one. Let's talk about a little bit more about how Fannie Mae and Freddie Mac fit in, right? They are huge players in the secondary market. They buy the mortgages from the lenders, they bundle them into mortgage backed securities, and they sell them to investors, right? This process, because it's almost like a government agent is buying those loans, this helps make the loans more affordable for consumers because lenders have steady funds to lend out with. And that's really important because if you have constant transactions happening in the market, that creates flow of capital and it makes people not act as tight because as you can imagine when you start tightening things up, then you have a lower appetite to lend out on. When you have a lower appetite to lend out on, then capital slows down, and when capital slows down, investments slow down. Just like buying activity, just like buying activity for homes, right? Let's talk next about the loan application and underwriting. I'm just looking at my notes here. So when you do your loan application, you're going to fill out paperwork about your job, how much money you have in your bank, what debts you have in place, and the lender's going to check your credit score, your debt to income ratio, and underwriting is where they just confirm everything, right? That's actually a great word. Like they're confirming everything, and if something looks off, they're going to ask for more details. Typically, you submit everything, and then the underwriter come back and ask some questions, and they'll say, "Hey, can you provide the source of these funds?" Blah 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 blah. Right? You want to be super honest, and you want to provide those documents quickly because usually you have a financing contingency, right? When you make an offer, and if you don't have a clear path to close, that's not a great situation to be in because you could be at risk of losing your EMD if your lender is just not responsive enough. So that's why I always err on the side of work with a lender that you know have helped somebody close before. Very, very important. You want to make sure people are responsive, they're on top of their files, and they keep things moving along, right? I like to think of it as underwriting as how do I explain to fifth grader? Think about a security guard that checks your backpack when you go to a theme park or a concert, right? They got to make sure everything in the backpack is okay before letting you in with the backpack, right? Make sure there's nothing dangerous in there. Same concept here. Now, when it comes to lending, right, there are fees, there are closing costs, and usually primary lenders they charge fees for origination, processing, appraisals. Oh, they usually call these origination fees like points, right, which is a percentage of the entire principal amount that you're borrowing. But there's a secondary market, and they don't charge you directly, but usually it influences interest rates. So if the secondary market is tight, just what we talked about with Fannie Mae and Freddie Mac, then rates typically go up, right? Because there's less capital around. And that's how your monthly bill could rise if you go out and buy a new loan, as buy a new property and get a new loan, as an example, right? It's just if you're running a lemonade stand and the price of the lemons go up, your lemonade stand probably might want to raise prices too to keep the same level of profitability, right? Obviously, it's an option, but the secondary market puts pressure on how you price your products. Now, we talked a lot about interest rates, and I always try to make sure people understand that the 30-year mortgage interest rate is heavily affected by two things: the actual interest rate on the 10-year treasury yield and the spread between the 10-year yield and the 30-year mortgage interest rates. Now, historically, that spread has been between 1.5 to 2% on from the 10-year yield to the 30-year mortgage interest rates. But we've seen it as high as 3%. And that's how we saw interest rates in almost near eight a while ago. And that's when essentially the whole housing market froze over. But if you look at the 10-year yield now for the past 12 months, right? We peaked at roughly 4.6 and 12 months ago. We touched 4.8 just 3 months ago. And now we had a low of 3.6 ish in middle of September, October last year. And now we just went back underneath 4 percentage in 10 year yield. And on top of that, the treasury yield has narrowed. So this tells me that one, it's getting into the optimal time to start buying, because if you're trying to time the market and try to time the bottom, it's going to be really, really hard, right? No one ever recommends that. But you also have to understand that the spread has also narrowed already. So if you even got back to 3.75, I mean, you only got about a quarter point left now of difference in the interest rate. So this could be a good time for you to start looking at, hey, maybe this is the time to start looking at buying a property. Again, this is not investment advice. I'm not soliciting any investments on this call. This is not legal advice. I'm not an attorney. I'm just simply sharing with you what I learn every single day and what I wish someone would have taught me from day one. All right. So hopefully this was helpful, everybody. I really hope that you pay attention to the 10-year treasury yield and not just looking at headlines or news headlines about what's happening out there. Don't just focus on the Federal Reserve is cutting rates or not cutting rates. Focus on their sentiment, and then more likely than not, the bond market is going to move way faster than the Federal Reserve, right? If they see the labor market breaking, 10-year yield goes down. If they see the economy slowing down, 10-year yield goes down. Similarly, when people see a lot of risk in equities in the stock market, they're going to shift their allocation of their funds towards bonds, which is safer. And the more money that piles into bonds, it drives down the interest rate. Okay. All right. So hope you all had an amazing Saturday, everybody. Hope you all spent some quality time with your family and friends today, because that's what life is all about. Thank you so much for joining with me on my lives for 554 days. It's been it's been a great ride, and we're gonna keep doing it one more day at a time. We're gonna stay consistent together, and my hope is that you copy my homework, right? You analyze and talk about the same topics I do, because guess what? Your kids are gonna be looking to you for information, for knowledge. And what better way to be a better parent than to share the information that you've acquired over your lifetime and be able to boil it down to the need to know points, right? You don't have to go so deep into everything, but if you're able to at least explain it in a way that makes sense at a high level to a fifth grader, then that's when you know you've done your job. All right. Have an amazing Saturday, everybody. I'll see you back tomorrow for day 555. Have a good one.